Hey guys, Josh here. And today I'm going to talk about cash secured puts. This is going to be a continuation of last week's training. So last week I did a video on. I'm trying to get the screen set up here. I did a video on. Yep. Covered calls. So I started out by purchasing TQQQ. I bought that about a few weeks ago, actually, maybe about a month ago, because I think I've done covered calls on it 4 weeks in a row, maybe 5 weeks in a row. But I got in at about $38, and I'd set my strike price around 40, 41, 42 uh, over the past 4 or 5 weeks. Finally got assigned last week, last Friday, when the market closed, the strike. Again, I got in at 38. You can see now that TQQQ is a little almost it's approaching it's 42.70, so it's approaching 43. But previous close was last Friday. That was before Labor Day weekend. I had my strike price at $41.50. Collected some nice premium for that. But because it closed above $41.50, that means I got assigned. So all my shares of that stock I'm forced to sell, and the buyer gets all those shares. So now I have all the cash back in my account, right? I no longer own those shares, but now I'm continuing the wheel strategy and it starts over. So now that I have all this cash in my account, what I do now is I do a cash secured put. And what I do typically when I do that, I'm going to look at this chart here and I'm going to go to, well, let's just go to an advanced chart. Okay, and I'm going to go to the 1 month history. And this is kind of where I look at for my levels of support and resistance when I'm trying to find whether I'm doing a covered call or whether I'm doing a cash secured put. I usually go back on a 30, I look at the 5, 10, and 30-day history on a stock, and I want to know where that price is. So 42 is a little bit above 42 is definitely the high right now. Where it's at right now is the high for the past 30 days. Okay. This black line here is your moving average, so it stayed pretty consistent. And then here's all your closes for the last 30 days. So if I were to draw a line, and I can probably do this in paint, which is what I normally do. I normally like take a screenshot of this, put it in paint, and kind of draw my imaginary lines. Looks like support over the last 30 days. I would put somewhere like here's the bottom at $36.40. Okay. Went up a little bit higher, came back down a little, and then went to 37. So I would say support is probably going to be just below $37. If that's 36.40 and this is 37.16, probably like 36.75-ish, somewhere around there. Somewhere in between there's where I would put my support line for dipping down. So that's where I'm going to sell my cash secured puts. I'm going to sell a put, and that's how you do a cash secured put. So you have to have the cash in your account to buy all those shares. I'm going to do a cash secured put, and the strike price that I'm probably going to choose, I'm probably okay. I'm probably happy picking this up around 37. So what I do is I go into Fidelity, and I use Fidelity Active Trader Pro. Today is September 5th, and so I'm looking at the option chain that expires on September 8th. Here in the middle are all your strike prices. All of your calls are on the left-hand side. All of your puts are here on the right-hand side. So if I was to go down all the way to 37, look, if you choose the top 20 strikes, 37 is not even on there. So if you looked at it, you can expand this. It'd probably go down to like 1 cent, 2 cent, 3 cents. So that's like really stupid cheap. If you're trying to collect premium on that, you're just not going to do very well. You're just not going to make a lot of money. So going up to the next dollar point, 38, that's only 4 cents. That sucks. $39, that's 8 cents. That sucks. $40 sucks at 16 cents. $41.35. That's not terrible. Like it's not great. I'm not happy with it. And then 42 is at 68 cents. So the reason usually when you see things like this, when in my opinion, when all these prices they're going to pay you per contract or really per share in a contract, if they're that cheap, it's probably because they expect the market to go up. So let's come back and let's look at this chart again, and you can see here's a low point of 37.16, and that was on 8/24. So that was that really wasn't that long ago. Let's go look at a calendar. 8/24. So 1 week, not even, this was like a week and a half, not even 2 weeks is when it hit that low. So it is on an upward trend. I don't know what all that stuff is. It is on an upward trend, and maybe the market thinks that it's going to keep going, but I'm going to buy that cash secured. I'm going to sell that cash secured put at a discount. So I might have to go right here on the SMA, well, since we're above it. That's at 41 bucks. I might just have to do there just to get really any decent premium at all. And right now it's only paying 35 cents. So before I just like pull the trigger, right, and go ahead and do that, I'm going to go ahead and open the chart and expand this a little bit. I'm going to change some of my settings. The default setting, at least for Fidelity Active Trader Pro, is the OHLC. That's the open, high, low, and close. I always just change it to candlestick. I like that better. So right now, this if I were to sell this put, it's like 33, 34 cents, which kind of sucks. And I got a big red candle, or big red volume. Sorry, big red volume, over 1,000 shares. Over, oh, that's anyway. The volume is over 1,000, which is a really good volume. So that's a giant one. You had a big red, and then the price fell, and then you got another big red. So I would anticipate that this price would continue to fall. But look at, I mean, it started out the day up here at the high, like in the 58-cent range. 56, 58 cents, dipped a little bit, climbed back up, crashed all the way down here to about 40 cents, climbed a little bit up to 48 cents, crashed down to 34. So I don't really like this pattern. So what I'm going to do is see if I can use a snippet tool here. Where's that snippet tool I downloaded? No. No. Oh. I need to bring this into MS Paint is what I need to do. Yeah. Take this, just kind of grab it like this. Okay. And I'm going to take that, just paint, and then paste it here, just to kind of give you some lines here visually, like what's going on. So you have maybe white lines probably work better just to show you. So get my lines here. So you had an uptick here at the beginning of the day, right? And then you had, geez, come on, just stay. Then you had a down, right? And you went back up, and you crashed all the way to here. That was a big down. Came back up to there, crashed down to here. So just as if I were going to use a predictive model, I would probably go with like something like this, like that angle right there. So I would assume my predictive model here, it's obviously not there yet, kind of went up, fell down, went up a little bit, fell down lower, went up, fell down even lower, went up. So I think it's probably going to go up to 40 cents. So that's probably where I'm going to be looking to sell a put here at 40 cents. And then maybe it drops all the way down to, like, if it goes to a lower low, I mean, it could drop all the way to 20 cents, which is okay. If I make 20 cents per share, it's 20 bucks per contract. If I can sell, several hundred contracts, not a bad deal. So right now we had this giant red candle right here, and it went down. It might continue to go down. But the pattern for this morning has been every time it's gone down, it climbed back up, took a big hit, climbed back up, took a big hit. I'm just predicting that it's probably going to end up somewhere in the 40-cent range. So that's probably the price I'm going to look at. So I'm going to close that. Don't really have to save it. We're down to 33 cents. And, based on the lines that I drew in the timeline, it's probably going to, I'm using 1-minute candles right here. So I'm going to say somewhere in the next 15 to 30 minutes, which is going to be longer than this Zoom call, most likely. I'm I would predict that it's probably going to get up somewhere in the 36 to 40 cent range. May go higher than that, but I think it'll get to 40. So I'm going to set my price and say, go ahead and sell this put and collect premium on 40 cents per share, which is going to be $40 per contract. And it's just multiply $40 times however many contracts, whatever cash you have in your account. Uh, that's how much you can sell. So, and you can calculate that if you go to look at this price, right? So it's $42.57 a share right now. So you go out and you buy 100 shares. All you have to do is move this decimal over 2 places. 100 shares is going to cost you $4,200, 42.57. So you can sell a cash secured put, represents 100 shares. And it'll take you $4,257. You could sell one put if you had a 4,257 dollars in your account. You could sell one contract. So just to make the math easy, I'm going to say every $4,200 roughly, right? If you want to round up, that's fine. Every $4,300 you could sell one contract. So if you've got 4,300, you can do one. You move that decimal over. You can do so you can do 10 contracts. Okay, instead of 4,300, you need 43,000. And if you want to do 100 contracts, you just need $430,000. So I'm in one of those ranges. But that's what I'm looking at, just based on the history. It looks, I think this is probably going to come back and hit that 40-cent price range. And based on the time frame, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 16. That's about 16 candles when it was up here at 46. So that's 16 minutes that it's had that drop. I'm gonna follow this and stay tuned. I'll post it on the Options Trading 102 Facebook group. That's where I post some of my stuff. I would guess that it's probably if it's even going to get to 40 cents. And I hate to use the word prediction because I don't want people to think, oh, well, he's making predictions. I'm not really making a prediction. I hate using that word. I'm going to say if it continues to follow the trend that it's been repeating all morning with those up down up down up down patterns, it looks like it'll probably reach 40 cents here in the next, I'm going to say 15 to 30 minutes. And that's where I want to try to sell a put. It's called a cash secured put. And then what happens is I collect premium for that. Now, what is that? So if you want to sell one put, if you want to sell one contract, right now it would cost you 42.50, or this on the actually be this times 10, but you have to have the cash in your account to do it. So it costs you $4,257 to do that. And then you would collect $40. If you sold that put at 40 cents, you would collect in your account, you would make $40. People are like, well, that's kind of stupid. Why would you put $4,200 at risk to try to make $40? In my opinion, that is the wrong way to look at it. I don't feel like I'm risking $4,200 because the only way that I cannot lose that money. Now, what would have to happen? Let's say that I buy it at $42.57 a share. In order for me to lose that money, TQQQ, which is the entire Nasdaq index, which is the top 100 technology and top 100 by asset class in the world on the entire planet, all 100 companies would have to fail before September 8th in the next 3 days. So I'm gonna say there is a 0% chance that $42 stock is going to go to zero. So I'm not really risking $4,200. What I'm doing is I am going to be collecting $40 in premium. I look at it as just for having the option to buy those shares. And if I do, what I'm going to do is I'm going to set my strike price here. I go ahead and minimize that. And what did I say? I'm going to get it at 41. And now it's fallen all the way to 28. It's probably going to come back up. So another question that you might be thinking about, and because in my opinion, it's a natural question. So you might say, or you might ask, hey, Josh, if you're already planning on doing a cash secured put, when this $41 strike on the put side reaches 40 cents and you think it's going to reach 40 cents, why don't you just come over here and buy calls in the meantime? So that this one, you can make the money going up and down. Uh, that is, no pun intended, that is an option. You can do that. You'd have to come over here, and you would have to pay up front. You would be buying a call, $1.90 at $1.96. So that would cost you $196 to do that. Obviously, the price is right here, 42.69, so it's already above the $41 strike. So it's not that you can just choose to buy or sell whenever you want here at 28 cents. You would want to buy a call so that you catch the uptrend. And if you look at this, go ahead and look at this chart. $1.96 on the up chart. So if you bought it here like this morning, like it was fantastic, right? While the put side was crashing, this one was, on the call side, it's going to be exploding. And that's always going to be the case. These charts are the call chart and the put chart are almost always going to be opposite of each other. They're not going to be mirror images, but they're usually pretty close. So you can see here the huge uptrend on the call side at the $41 strike. You could have gotten in at $1.30, and right now it's $1.96. That's a nice little $66 per contract. So that's pretty nice. And then on the opposite side, here's the put on 41. You can see it. Well, that one was going up. This one's going down. So if what I like to do, when I'm doing cash secured puts or covered calls, I usually pull up the call chart and the put chart, open them side by side, look at the price action, which here on both sides has been pretty significant. Obviously, it's a plus day. I can lower this down here, although the NASDAQ is down, so that's kind of weird. Maybe it's taking a dip, but on the call side, you can see it trending and climbing up. This was at let's see what time, up there at 10:05, and now it's 11. This is all Eastern time, so they're using market time. So a little bit over an hour. It took about an hour to climb from $1.30 to $1.96. If you had purchased calls, a naked call outright, that was a really good move. I didn't do that. But on the so if the strike price is going up on the call side, then it's going to be going down on the put side. Okay, so these are going to be natural inversions of each other. So if you took this put chart here and you just kind of flipped it upside down, it would obviously the candles are not the same, but the pattern when it dips down, goes up, and then drops. Okay, you saw the same thing here. It goes down, dips up, and then rips up. So they're almost inverse. They're not mirror images of each other, but if the call chart's going up, the put chart's going to be going down, and vice versa. If you have a down day, anytime you see a put chart that's going up, the price is increasing, then the call chart is going to be going down. So I usually like to open both just to see where the volume is, where the price action is. Kind of tells you what the market is doing. Since I'm trading TQQQ, this is the entire NASDAQ index. QQQ is the NASDAQ stock, and then the T in front means that this stock is triple leveraged. So it's going to do triple whatever the NASDAQ does. The good news is if the NASDAQ does 1%, this stock is going to do 3%. If the NASDAQ loses 1% in a day, this stock's going to lose 3% a day. So it is triple leverage, which means it's going to be triple in either direction. But if you are a believer in the stock market going up over the long term, as I am, then if the NASDAQ, let's say over a 10-year period, averages 8%, why would you want that when you could average 3 times that and get 24% on the exact same companies, on the exact same stocks, on the exact same index? If you had to choose between getting 8% or 24%, that's a no-brainer, right? Take the 24%. So what's the downside? What is the potential risk? Well, the potential risk is if in the next, let's say, 10 years, if the NASDAQ goes down for some reason, which I do not anticipate that will be the case, but let's say you were negative Nancy and you're into buying puts and shorting the market, and you believe there's going to be a terrible crash and it's go down, then instead of if the NASDAQ over the next 10 years was down 8% and you bought TQQQ, then you would be down 24%. You'd be down triple. So, but I like it. I think positive. I believe in the long run, that the Nasdaq and the Dow and S&P 500 and the Russell 2000, all of them over time, because they've all got a lot of the same companies in them, are going to continue to go up over time. You're going to have good years, you're going to have bad years, you're going to have up markets, you're going to have down markets, but in the long run, over any 10-year period, especially if you're looking at 15, 20, 25, 30 years out, which is the time frame that I look at. I have a infinite timeline, until I die. I'm looking at the market long term going up. So this is why I like covered calls. I like to buy things like I did probably 5 weeks ago. I bought TQQQ at 38 bucks a share. I sold covered calls at a higher strike price, around 41 bucks. And I just collected premium 5 weeks in a row. And then on the fifth week, my strike price was 41.50, and it closed at 42 and change. So I got assigned. The cool thing is, I got all of the appreciation between the $38 and the 41.50. So I got 350 a share on that, just on the stock appreciation. Plus, I made like another 10 grand in those 5 weeks, just on selling the covered calls by collecting the premium. Now that I no longer own the stock because I got assigned, because it closed at 42 and change the other day, last Friday. Now I just have a pile of cash in my accounts, and now I'm going to be looking to do cash secured puts, which means I'm going to do two things. Hopefully, I'm going to collect premium up front, so I get paid just for selling the put. Doesn't matter what happens, doesn't matter what the stock does, doesn't matter what the market does, doesn't matter if the market goes up or down. Okay, if I sell a put, I'm collecting premium. I'm going to get paid for every single contract that I sell. And then the only way that I get assigned, which is actually a good thing, I'm going to probably do this at 41 bucks a share for my strike price. That's why I'm looking at the put 41, the call 41. It's at 42.60 right now. If it drops, if this Friday, if this stock closes below $41 a share, that means I'm picking up all the shares at 41 bucks. I'm picking it up at a discounted price, at least a little bit lower than it is right now. So ideally, I'm collecting premium. If I get assigned, that's okay. I have to buy all that stock at 41 bucks, which is better than buying it right now at 42.66. And then if I get assigned and I'm forced to buy it at $41 a share, then the next week, starting next Monday, what I would do is I would sell covered calls again. So since I bought the stock at 41, I'd be looking to sell covered calls probably around, I'll have to look at the options chain, but probably around the 43, 44, $45 price range, and see what kind of premium I can collect. And again, like usually it's in the 20 cent, 30 cent, sometimes 40 cent range, but a lot of times I get this in the 20 to 30 cent range. Last week, because the price was so close, I think it was around $40 or so at the time, and I was selling covered calls at the 41.50 strike. So I was paying like the 90 cents a contract, which is super juicy. That was really nice. And then it closed above. So I got to double dip there, which is ideally what you try to do every week. So I'm going to be looking at $41 strike price, doing a cash secured put. Probably put it in here at 40 cents. If it doesn't hit, then I'll just, I'll just go. What I do is I'm going to go ahead and put in limit orders on this for the accounts where I trade. And then I'm done for the day. I'm just going to put in the limit orders and say, hey, like if it hits, great. If it doesn't, then I just log in tomorrow and go, oh, okay, well, it didn't hit my price. I'll come in, I'll look at these charts, I'll do it all over again. But I'm looking to do cash secured puts. Collect some premium, and then if I get assigned at a discount price, I pick up the stock a little bit cheaper, and then I can turn around and do covered calls. So that's called the wheel strategy. So that's about all I've got for today. Stay tuned. I'll be posting this on the Options Trading 102 Facebook group. I'll take some screenshots and show you guys what I'm doing. But hope you guys enjoyed this. Hope it was educational. Happy trading. Be careful out there, and God bless.